Hello, Baku. Nice to be here.
Yeah, nice to see you again.
How's the weather in Dubai? Sunny?
It's sunny. I'm getting much better now, so we have spring.
Always making me jealous. It's looking like rain out here.
I didn't miss at all.
Yeah.
Okay, let's wait a couple of more minutes.
Yeah, it's great.
I think you were recently in Dubai, right?
Yeah, I was for the expo there just a few weeks ago. It was lovely to be back. It was really nice to be traveling because the airports were much quieter.
Yeah, true. Okay, I think we can start. Hi, everyone. As you know, today we are hosting Giles Coghlan. He is a chief currency analyst in HYCM, and he is based in the UK. Last year, we hosted him 2 times, and he gave a speech about the seasonal price patterns in financial markets and the impact of COVID on financial markets. It was very inspiring and very engaging, and we get very, very good feedback from the students. So today he will talk about the technical trading. I hope you enjoy it. Thanks, Giles, again for being here.
Oh, thank you very much. It's always a pleasure to be speaking, and thank you for hosting me, Professor, and thank you as well for the students in the previous meetings who asked questions and engaged. So as we go through this webinar, this is a very important topic, and it's one topic that I'm really pleased that you have asked, because this was the feedback that I was getting, was asking how do professional traders use technical analysis to make trading decisions? It's probably one of the most important questions that you can ask. I'm gonna peel back the curtain and show you exactly how I use technical analysis. I'm also going to explain why I use it. I'm also going to point you to an excellent resource if you would like to study more technical analysis yourself, from the Chartered Market Technicians qualification. I'm going to give you one of their recognized textbooks. So if you want to delve into technical analysis in more depth, I will show you some of the nuts and bolts and how to do that. So before I really get stuck into the webinar, let me just introduce myself. Now, I am a chief currency analyst. I am a director of my own company, GCFX Limited, and I am a consultant for HYCM. And I perform a range of functions explaining market moves, writing newsletters for clients. And the heart of my role is essentially making sense of market moves, both day to day and from the week to week and month to month. I'm also used by financial media across the world to communicate sometimes complicated financial concepts in a way that's simple and easy to understand. So I appear a couple of times a month, CNBC Arabia. I'm appearing on Thursday at 1:30 UK time, 5:30 Dubai time, and Bloomberg Ashraq, as well as Yahoo Finance, and a whole range of media in the UK. Reuters, I often get a call from them asking about latest commodity moves or latest market moves. So I essentially fulfill that role. On top of doing that, I also have my own private fund, which I trade. And as part of this webinar, I'm going to show you some of the trades that I've taken in my own private fund, and exactly how I've used technical analysis as part of my overall process in trading. I also provide a daily webinar to a number of clients, sort of 50 to 60 clients, attend a daily webinar where I explain market moves that have happened and help my clients get ready for market moves that are about to happen. So that's really what I spend most of my time doing. And you know, you've only got to Google my name, you see all the different range of places where I pop up. Now, the key to understanding how professional traders use technical analysis is to first of all understand that trading is not a question of one skill. Successful trading, particularly for professional traders, involves combining a number of skills together, and they can broadly be broken down into these 5 key areas. Now, if you don't have one of these 5 key areas, often the whole structure of your trading ability will fall down. This is why trading is so incredibly challenging, because the level of skills that are needed are wide-ranging, quite diverse, and it's a very tricky concept. But you essentially need these 5 key areas. And if you think of it a bit like maybe like a mousetrap, you know, in a mousetrap, you've got a board, a spring, you've got a little clip that holds the bar in place, you've got a coil. If you don't have just one of those parts of the mousetrap, the whole mousetrap fails to function. So the first thing you need to understand is that professional traders use technical analysis as one component, as one part of a wider skill set. And you can see here the fundamental analysis, risk management, trading psychology, and sentiment analysis. Now, each one of those topics could be a multiple series of lessons. So by necessity, due to the limitations of time and mental capacity, we have to break this down and look at a very small component. But it's very important as we start that we understand that technical analysis forms one part of a wider skill set. Now, one of the reasons many people struggle with this is because technical analysis is the easiest skill to teach. It's very simple to communicate, particularly in a digital format. And obviously, with the acceleration that we have experienced in the digital age, it's very easy to send a technical analysis to other people via the internet as a way of sort of drawing people in. And some of the negatives of that have been that some people have been vulnerable to technical analysis reports and technical analysis trading systems, which actually would be very difficult to put into place in a real world environment. So this technical analysis we're looking at is, in one sense, is not complicated. But what we're looking at today is a more nuanced approach. We're looking at how professional traders use technical analysis. So in order to answer this question, we really need to ask 2 questions before the third, and they're as follows. So first of all, we need to ask ourselves, what is technical analysis? Just to make sure we all have a good understanding of what technical analysis is. You know, there's an old saying, assumptions are the mother of all mistakes. And that's very true, isn't it? So we're going to make sure we're not making any assumptions in order to accurately understand the question before we can even begin to answer it. The second question is, why do traders use it? Because that's important as well. Because understanding why professional traders and people with a professional trading background like myself use technical analysis will give you a good indication of the how as well. And finally, we'll be looking at how professional traders use it. And I just thought, you know, there's no time like the present. And what I will be sharing with you is 2 trades that I'm currently in the precious metals market with both gold and silver. And I'll be showing exactly how I've used technical analysis to make those trades. And I'll also show you a trade I would like to enter, and I'm going to be showing you exactly how I'll go about using technical analysis to decide when, where, and how to enter the trade. So I'm hoping this is going to be a really good snapshot for you, and by the end of it, you should have some really, really good insights that will be born out from live market conditions, and you'll be able to follow along in the days and weeks and see how these things work out. So I think that's the most interesting thing for you as students. Please do ask questions as we go along. I am the sort of person that I don't like it when people get confused and don't ask questions. There's absolutely no reason that you should be confused. Please do ask a question, and that helps me to know how I'm teaching and if what I'm saying is making sense. So do ask questions as we go along, and I'll be very happy to answer them as we go. So without further ado, let's get into question number one, which is, what is technical analysis? Now, technical analysis is very, very simple. And I'm going to share with you a book in a moment that will really help you delve into this in detail. And it is the book that I both recommend to aspiring traders, particularly traders who want to start to learn technical analysis. And it's the book that I also reference myself, and I use it as a reference book when I want to refresh myself on a particular aspect of technical analysis. And technical analysis is simply this: it's simply the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. It's the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. That is our working definition. It's a working definition taken from John J. Murphy's book, which is referred to by some as one of the core technical textbooks, and is also the a key textbook for the chartered market technician qualification. So it's a very, very good book. Now, it should cost around £50 UK. If you ever want to delve into this yourself, make sure that you don't buy the study guide. The study guide is sort of on sale for sort of £13, £14, and you think, aha, I've got a bargain. But no, you've accidentally bought the study guide. The main book is well worth getting, and it's worth getting the hardback edition, because, as I said, you will refer to it in the future. So that's what technical analysis is. That's our working definition. And why do traders use it? Well, traders use it for a very, very simple reason: for deciding where to enter the market, where to exit the market, and how to manage risk. That is the reason that traders use technical analysis. Or else, you think about it, say you had a bias to buy a precious metal. Say you had a bias from a fundamental perspective to buy gold. You thought gold was going to rise, as I am currently thinking and have been thinking for a while. Now, here's the question: where do you enter? Do you still hold your position if gold loses value by $10? What happens if it loses value by $20? How about $30? Are you still going to hold? Technical analysis is shared parts on a price chart where it is obvious to use your entry, your exit, and your stops. So technical analysis primarily helps us manage risk and find obvious areas to enter. So that's why professional traders use it. They want to know where to enter, they want to know where to exit, and they want to know how to manage risk. Those three aspects are what technical analysis is very, very, very helpful for. And I'm going to share with you, as a simple bonus, how simple technical analysis can be. And some of the technical analysis that I use is so simple that even a small child could actually use it. And I'm going to show you that very simple method. And although it's simple, don't be mistaken and think it's not profound. Sometimes the simplest actions and the simplest methods can also be the most profound. And I'm going to show you one simple technical analysis, and I'm going to show you then why and how to use it. And I'm going to show you how to dovetail technical analysis and how professional traders use it in line with fundamental analysis, and I'll show you why that's key. If that's a little bit vague at the moment, don't worry, because it will become crystal clear as we go through the presentation. So I'm going to show you one very simple way to use technical analysis, and the technical analysis I will be using is I'm going to be showing you how to use a trend line. Now, a trend line is very simply a line that's drawn along a succession of peaks or dips in price. So if you look on this screen, you can see the number 1, 3, and 5 with an ascending trend line drawn through the valleys 1, 3, and 5. Now, when you're drawing a trend line, it gives you an indication of key areas where buyers and sellers are likely to enter and where risk can be managed very carefully. There's all sorts of ways to use this, but I'm going to just show you some examples, and then we'll go over to the charts and I'll show you how I use a very simple trend line to enter a gold position long, and I'll show you how to do that. So that's an example of a trend line that's ascending. That's an example of a trend line that's descending. Now, how do you draw a trend line? This is very simple. Yeah, higher high, higher low. You've got it. Now, this can appear to be very simple, but there are some finer points about when you're doing this in real time. It's very easy when you see a trend line like this that's historical and you have all the peaks and the troughs marked 1, 3, 5, 7, etc., etc. But what you do is a trend line needs a minimum of 2 points. So if you imagine before price gets to, if you go with me from 1, so we have 1, we have a move up to 2, we then a move down to 3. Now, you need a minimum of 2 points to draw a line. Once you have 2 points, you have what's called a probable trend line or a possible trend line. Now, at what point does number 3 become a higher low? At what point does it become a little trough that you want to draw a line through? Now, there's different schools of thought, and none of these schools of thought are particularly wrong or bad or better than each other. They're really just different. So some people will say a trend line, a point can only be drawn at 3 once the price has moved greater than 50% back up to the previous peak at 2. Other people would say, no, a trend line at 3 can only be drawn once price has moved back through the previous high at 2. Now, which one you choose is actually really up to you. Because I'm a shorter term trader and just tend to be moving in and out of the market more quickly, I prefer to use a trend line that would be, once we're sort of halfway up to the previous high at 2, I would consider that point at 3 as sufficient for a possible trend line. So once I've drawn the 1, the 3, then a trend line is only confirmed as a trend line when you have a move back down to 5. So you see 1, 2, 3. When you've got 1 and 3, you've got price moving either through the highs, the previous highs at 2. Let me just show you so that this is, so it's either, that's it. That's it. So it's only a 0.3 when price has moved 50% between that point to 2, or whether it's taken out those highs. When it moves above those highs, that's when that trend line can be drawn. Now, the trend line is only confirmed at 0.5. Now, so as price moves down to that area there, it's only when price has moved up either to the 50% region here that you can say a trend line is in place, or if you have a different school of thought, it's only when that previous high is taken out. I use that one because it almost always is good enough, and very rarely does it disappoint. You're always going to be thinking up at previous highs and watching price carefully, and once you make that 50% move, you tend to get a retest of previous highs anyway. But at that point, you would have the trend line in place. Okay, that would be when a trend line is confirmed when 0.5 has moved. Yeah, thank you very much. We have a question. Where do you place the trend line? On the wicks or the bodies of the candles? Wicks, you ask? Now, this is a very, very important point, and I am so glad you brought it up. Now, you will have some people who will draw a trend line through the actual wicks of the candles. Now, I have noticed over the course of my trading career is that is a far, far inferior way of drawing the trend line. The very best trend lines are ones that have no price above them or no price below them. And according to John J. Murphy, he also says that you should only draw the trend line where there is no price. So in other words, you want to have no price breaking through that trend line. Now, I know some people would maybe like disagree with that, or some people would say, no, you know, you can have, sorry, my light's just fallen down. Let me just correct that. Oh, there we go. Okay, there we go. Okay, that's better. Sorry about that. And sorry, my cat's come to say hello as well, so I just put them over there. Yeah, no, so some people say, you know, you have to do it with drawing through the lines, but that is not necessarily the best way to do it at all. And I'm going to give you some examples of that. I'm just going to pop them out of the room. Come on. So it's a great question. Tima, I will show you that when I show you the trade that I've taken on gold. I'll show exactly how to draw this on charts. We'll go through examples, but just know that your question is an extremely important question. I am really glad you asked it, because it is something that people go wrong on this time and time again. I'll explain to you how this works. Now, when you have the trend line, you then use this trend line as a buying area. And the reason you use it as a buying area, you see that 0.7, that trend line, once you have those 3 touches, is a valid trend line that's highly respected and will be observed by traders around the world, particularly on the higher time frames. So I'm talking about the daily chart, the weekly chart, and the monthly chart. That means that as price moves back down towards 7, there'll be a whole host of buy orders at 7. So for instance, let me show you how it's used. So let's say, right, imagine this is a market and you are convinced that price is moving higher, but you don't know where to enter. You don't want to just enter anywhere. You don't want to enter up here and just buy here, because you think, well, look how price, where do I buy? Well, you think, I want to buy at a place where technical analysis really confirms a sensible entry. So you might think, okay, well, that previous high is a good place. That's also in line with the trend line. And so you would say, wow, 0.7 is a great place for me to buy, because I can limit my risk to this. I can put my stop below this point. Now imagine you've bought here at 6. Where do you need to limit your risk? You need to limit your risk in the same place, because if price moves there, are you wrong? Not necessarily. Are you wrong? Not necessarily. Are you wrong? Not necessarily. See, it's only when price moves below this point that you'd say you were wrong. And if you were here, look, you've got to endure what's called drawdown. Now, traders hate drawdown for a couple of reasons. One, it's stressful. It's horrible. Secondly, not only is it psychologically uncomfortable, but it means that you are allocating funds that you could be using elsewhere. So technical analysis helps you to limit your risk. It helps you with your fund allocation, that you're not unnecessarily tying money up in markets which are likely to retrace, because markets always move like this. They go up, they down, up, down, up, down. You know, if you look at behavioral finance, you'll see that this is just a very, very typical psychological, you know, response. So you would use this area for buying. Now, let's say you were here at price 8 and say you thought, well, I still think there's buyers who are going to be coming here, right? Well, then all you do is you put your order here. And where do you put your stop? Well, you put your stop underneath this trend line about there. And then if price goes down, what does it tell you? It tells you you're wrong, okay? So you've only risked this amount of capital, okay? And that risk is just part of trading. You're going to have winning trades, you're going to have losing trades. I lose more trades than I win. So I'm about 45% winning trades, 55% winning trades, but my winning trades are greater than my losing trades. That's a very, very typical kind of trading statistic. So taking these small losses is available to you because of technical analysis. And when you do your technical analysis correctly, you will have small losses, but you know, you could potentially have greater gains. So that's how it works. Yeah, Omar asked a question. Omar says, I'm wondering about if there are any major indicators that show if a stock will go through a major boom or recession when looking at stock chart analysis. Yeah, so when you're looking at stocks, Omar, like at the moment, we've seen a huge boom in stocks, and that's been because of quantitative easing, with the huge amount of asset purchases bought, you know, across the central, across the entire Western world. We've seen equity markets on an absolute surge, and people have been buying equity markets and buying those dips over the last sort of 12, 18 months. So you're looking at low interest rates, you're looking at fiscal stimulus, you're looking at quantitative easing. There's all been major indicators for upside in stocks. With stocks, particularly with individual breakouts, you'll look at volume, Omar. So how much volume is there on a breakout? That is kind of beyond the scope of what we're doing here today. But if you look at John J. Murphy's technical analysis book, he has whole chapters on that subject. And you know, even if you wanted to look at that another time, you know, do suggest it to your professors. Anything that you like in terms of technical analysis, I'm very happy to go through it. Yeah, Gavin asks, are 3 touches on a trend line the general rule of thumb? Yes. So 2 touches, it's a probable trend line. 3 touches, it's a trend line. That's the kind of vanilla, orthodox answer. Now, I will tell you from experience, sometimes 2 touches is enough in certain markets. And I'll give you an example in gold. But the vanilla orthodox answer is you will want 3 touches of a trend line for the line to be valid. Yes, Anas, what are the most commonly used types of trend lines used by stock investors? Anas, that's a very easy question. Horizontal support and resistance trend lines, and these diagonal trend lines as displayed here. They're the two most commonly used types of trend lines. Okay, I'll give you some example of how to do some of these. So a trend line, a downtrend is exactly the opposite to a uptrend. Now, what you can use as well, these trend lines are then also very useful for signaling a trend change. Okay, now there's a type of technical analysis called a 1, 2, 3 reversal. It's a form of analysis. I use it all the time. So do you see point 9? At point 9, what do you notice? That price has broken down through the trend line. Okay, because price has broken down through the trend line, that is now a probable trend change. It's not a definite trend change, it's a probable trend change. Then you have a reversal, maybe if it moves back up towards rejects the bottom of that trend line, and if it takes out the new previous low, it will be a change of trend, a 1, 2, 3 trend reversal. I'll show you an example of that. Now, that means the trend line, this technical analysis, is very helpful for analyzing trend changes. Now, the way to use this, and this is important, is that you don't just use this as a purely like you're doing a maths equation, and you plot your lines in, and then, as you say, the trend line there, you know, as soon as price goes through that trend line, you think, aha, it's a trend change, I just automatically sell. That's not the way, and that's not the way professional traders use technical analysis. Instead, this is what professional traders do. They will be saying, okay, say you're at point 8, and let's imagine this is the oil market at the moment, and the oil market's there, and let's say all of a sudden President Biden suddenly says, oh, you know, OPEC didn't cooperate last week, and because OPEC didn't cooperate last week, and the CPI inflation tomorrow from the US is really high, oh, I'm worry. What can I do to help inflation in the US? Oh, I know, I can release some of our strategic oil reserves and flood the market with extra oil, which will cause prices to fall. So what you do there is you'd be like, okay, say price is at 8, and all of a sudden the news comes out on your news squawk saying President Biden announces that he's going to release, you know, 10 million barrels of oil into the oil market. Fantastic. For a trader like myself, I think, oh, that's wonderful. I can sell oil today and I can make a very quick profit for my fund. And what will I notice? Let's say I sold at 8, and let's say by the time the news came out, right? Let's say by the time the news came out, just gonna get my, there we go, okay. So by the time the news came out, that we're around price 8. And then you can see that price is heading towards that trend line at 9. So I can't see my cursor, so please excuse me while this is. I'm try and right. Okay. And then I know, well, hang on, that trend line is a significant one. This could be a trend change. So it might mean you might think to yourself, well, I'm going to hold this short more because this could be a trend change in oil. So what a professional trader and what professional analysts are doing, they're combining the technical analysis with the fundamental analysis, and that's how you use this to most effect. So you can see here back exactly the same for a trend change at 0.9. Now, this is how not to use technical analysis. Well, before I go into some examples, do not simply look at charts. This is what's often peddled on the internet. If you sort of Google technical analysis, you know, how to trade with technical analysis, you will be just shown a series of historical chart patterns, and people will just say, oh, you know, with this chart pattern, you do this, with this chart pattern, you do that. It's an oversimplification of trading, and whereas there are sort of successful algorithmic programs that have very sophisticated, technical workings. The general kind of just trying to look at charts yourself and look at technical patterns is inferior to looking at technical patterns in line with fundamental analysis. So remember I said those 5 key areas of success that are needed. This is the key to answering this question, is how do professional traders use technical analysis? Well, they will use technical analysis in line with fundamental analysis. And notice I put do this first. So every day when I am explaining to the clients who tune into a webinar I run each day, the first aspect that we're always analyzing together is, what is the fundamental story today? What is driving commodities, indices, currencies, cryptocurrencies? What is the driving narrative? Once we've found the driving narrative, then we use our technical analysis. So let me show you how that's done in real time. So these are 2 trades that I have on using fundamental analysis and technical analysis, using gold and silver. Now I'm just going to exit the presentation for a minute. I'll get rid of my, oh, that's it. Get rid of that funny drawing. Right, still not gone. Just bear with me. I just clear all drawings and get rid of that. Now this should go back to my normal cursor. Yes, it has. And now we're going to look at the gold chart. Okay, so here's a gold market. Right. Now, this is how we've traded this, and this is how I've traded this on my fund. So first of all, I'll show you something. Now, there are obviously nuances here, but I'm going to give you the rule of thumb. Now, this is a probable trend line. You've got one touch, you've then got a second touch, and you notice I've got no price the other side of this trend line other than this breakout candle. So I drew this in place. This is all done in real time. This is before last week. And this trend line was, yes, one, you could argue it's 3 touches, 1, 2, 3, but it's just 2 touches. It's a probable trend line, but it was good enough for me. Now, this was also another technical setup, and this is called a symmetrical triangle pattern. Now, the symmetrical triangle pattern, you need 4 touches, 1, 2, 3, close enough, 4. And you look for a break of the symmetrical triangle, and you look for a height of the pattern. So the pattern is like from 1912, 1920 roughly, down to about 1620. So you're looking about 17, 18, 19, 20. You're looking for about $300 higher, so back up to that sort of 2040, 2080 region. So the height of the pattern, that's the base of the triangle. You always look for a base of the triangle to the upside. So there's a lot of potential gains here. So with that trend line breaking, why was I looking to enter this? Because I entered this market before the trend line broke, right? Why did I do that? I entered it in, you know, around these prices. Why? Well, let me explain. This is where you do your fundamental analysis. Now, gold markets are driven by a few different things, but the biggest drivers of gold markets is the interplay between real yields and the dollar. So what, first of all, is a real yield? The real yield is marked here in orange. Now, the real yield is your nominal bond yield minus inflation expectations. So all the real yield tells you is what your actually yield for your bond is when you take inflation into account. And what you'll see is, look, when the real yield falls, gold rises. When the real yield falls, gold rises. Now, that pattern is accelerated when you also have the dollar doing the same thing as real yield. So when the real yields and dollar falls, you see gold sharply moving higher. When real yields and the dollar falls, you have gold moving sharply higher. Right now, what do we see? We see real yields moving lower, and we see the dollar slightly pressured. Yes, it's moving up, but this is the key bit. The Federal Reserve has just met. Now, the Federal Reserve has just met, and what they've said is they're going to be more patient than the market was perhaps expecting. They're going to taper bond purchases, but they're not looking at raising interest rates until at least the middle of next year. They dropped some of their talk about inflation being transitory, but they still expect inflation to pass. So in other words, they're not going to be raising interest rates very, very quickly. And central banks across the world have been dialing back the rate hike expectations. Was it the fall in SONIA futures markets? Was it the fall in Eurodollar futures? Was it the Bank of England policy shift, the Fed policy shift, the Reserve Bank of Australia policy shift? Yes, they decided that they would no longer have a bond yield curve target on their April 2024 bonds, which is hawkish and a bullish development, but they said they still don't think they're going to raise interest rates till 2024 anyway. So central banks around the world have been saying, whoa, 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 we're not going to be rising interest rates really quickly. Why? Because the inflation that's being driven is coming from supply chain issues. And central banks are worried if they raise interest rates to control inflation, they're also going to hinder growth, and that gives us a stagflationary environment. So fundamentally, the situation for gold is very good. And real yields are dropping, and you can see the constant move lower. And even today, look, 10-year bond yields moving lower again. Okay, they're just chipping their way lower and lower. Inflation, whereas remains elevated. We've got inflation out of the US tomorrow. We've got the producer price index being released this afternoon. So if inflationary pressures are remaining high, but the market still thinks the Fed's not going to raise interest rates to the middle of next year, that means real yields should keep moving lower. That is also a downward pressure on the dollar itself. So that's why we've seen the dollar just pulling away. Let's move that here. This is the dollar index. That's why we've seen the dollar just pulling away from that 94.50 region. Okay. Now, there are things that can influence this, and there are things that can change this outlook. But at the moment, the outlook looks pretty good. Okay. So that's why I reached that point. I thought, gosh, you know, I really do think the outlook looks very good for gold. Now, the entry was easy. For me, it was just like, oh, hang on. I could see that narrative moving. I've got this trend line we're coming up to. I didn't need to wait for the trend line. What I was actually doing is I was waiting for the non-farm payroll to be released. Now, if that was a very weak reading, I was expecting gold to burst out higher. Now, as it happened, the non-farm payroll jobs out of the US was excellent. But look, the market said we don't care. We don't care about a good jobs report. It's not going to change the Federal Reserve's perspective. They're not suddenly going to hike rates because of it. No, we still think there's a great upside potential for gold, and gold rallied higher anyway. So that was what I was looking to add to my gold longs if I got that. So in the end, I just kept the gold positions I had from earlier, just kept them on because I thought, you know, broadly speaking, this is good. And then, aha, brilliant. I got my trigger. The break of that trend line is a very bullish development. Now, I'll show you the finer points of this. So that was a trend line I was looking for. Go with the break. That means my risk is now managed very carefully. Okay. My mental risk now is if I go back below 1780, I'm thinking twice. Staying above, I'm happy as Larry. Now, I've also got this overhead resistance. Now you asked, what was the most common type of trend lines? I was asked by Anas. It's the diagonal trend lines and the horizontal support and resistance trend lines, okay? So here we have the horizontal overhead trend line that's called resistance. Now, Abdul, you make a very good point, and yeah, you got it, Anas. Abdul, I'll help you here. Abdul asks a very good question. How do you draw them correctly, support and resistance? Because it's kind of subjective from trader to trader. You've got it. Now, this is what you do. And I'm going to help you here. And I'll help you with some of my recent inspiration. Now, over lockdown, what did most people do? Ate a little bit too much. And this mental image will help you understand support and resistance, but I apologize, it may not be pleasant. When you eat a little bit too much, what happens to your belly? Well, your belly becomes a little bit fatter. And when your belly becomes a little bit fatter, you have to push into your belly before you kind of reach that point where you can push in no further. Now, depending how much exercise you've been doing and how much you've been eating, it goes further in or not so far. So when you're thinking of support resistance, you should be able to see my screen. Now, you see here, this is resistance. Now, people get confused. They say, oh, where's the line? Is the line here? Should I just do it through the body? Is the line here above the Wicks? No, when you have horizontal support and resistance, don't think of it as a line, think of it as a zone, a bit like a belly, you know what I mean? So now what we can say is gold is now moving in to this overhead resistance, right? You don't need to worry about that. Now, there's so many finer points to this, but I'm gonna do my best. So that's the first thing, Abdul. You get it? Think of support and resistance like a zone, not a line. 2, have that mental image of a belly. So in other words, you're pushing in. So sometimes price will move up. You think it's going to break out and then it snaps back. Now this example is perfect, right? Now I'll tell you why this is perfect is normally traders, you take profit as you head into these support and resistance areas. It's what you do. Because normally when price moves into this area, you take your profit. Now I'm not taking my profit. Why? Because I think there's more prices to come. Why? Because the fundamental story is strong. So now I recognize this resistance level. I recognize its traffic. But in my mind, I'm thinking, well, I've got 2 options. We might see a little sell from 1830. My price moves back up. Maybe then it moves back down to 1810, 1800. But over time, I'm expecting this level to break. Now, once that level breaks, previous resistance then becomes support, okay? So you see here, here's a good example. So you see here, that line there. So resistance breaks, and then it becomes support. That's what we're exactly looking here. That's resistance, resistance, resistance. If that breaks, you'd expect to move up to 1860, then that becomes support. So what I'm looking here, I'm looking for this to break. It may be that there's a retracement, and or maybe not. Now here's another little clue. This is a red hot tip, and if you get this, this will be something that will help you. Right, now look at this and have your attention hat on. Now this will seem like a contradiction to what I've said, but I apologize for that. This is just a higher form of knowledge essentially. Even though this is best understood as a zone, when it breaks out, it's very important to recognize a legitimate breakout. Now, do you see the wick of the candle? If price moves up through here and say the wick snaps back to 1830 and then snaps back under that level, that's not a legitimate breakout. But say this candle keeps moving, say today it just keeps moving higher, and say that price breaks just 1 point above that high here. Say it closes at 1834, so the body of the candle closes above that. That is significant. You might say, what, by 1 point? Yeah, even by 1 point, even by 1 cent above that line will be significant. Because breakouts are only really confirmed in many people's eyes with a break and close above the level. So even though that's best understood as a zone, if price was snapped above and then closed back lower, then, okay, you know, I might expect a bit of retracement. But if it breaks above and closes by just $1 over, just the tiniest amount over that top, then it's a legitimate breakout. And what you typically expect is this: you get a tiny retracement and off. So even though what I said is true, Abdul and Anas, about the overhead zone being zones rather than lines, still the furthest point still has a significance. And generally speaking, okay, yeah, Gavin says, would that top be the height of the previous wicks? Yeah, so the top would be there. Now, that would be the top area. So even though this is a zone, this becomes very important, a break and close above and woohoo, okay? Now, let me show you similar with, right. So I think you're starting to see the picture. Now, the other way I looked at this, and this is how I use technical analysis, and I was sharing it with the other members of the trading group which I take each day. I was showing that this is a candlestick technical charting pattern. That's called a Harami inside bar. Now, typically, when you get a Harami inside bar and it breaks higher like this, typically that will be a very key support level, and you'll see price continuing to move up higher from here. So let me give you an example. So, you know, this is kind of a trading, you know, this is quite a few hours in and of itself, right, to really master this. But here's an example. You see here, you've got an inside bar. Now, a Harami inside bar is when the body of the candle is inside the body of the mother candle. So that is now a Harami inside bar. When that breaks higher to the upside, it typically signifies higher prices, technically. Now, because the fundamentals were good here as well, you can see here that's a Harami inside bar that's breaking higher in the weekly chart through that trend line. So we've got two technical levels. And then look on the monthly chart, and you can see on the monthly chart, it's a Harami inside bar. Look, breaking to the upside. That's red hot. And on top of that, we also have gold prices, and gold prices have a very strong seasonal time of the year, running from now into the start of February next year. So if I just show you a quick look at Seasonax, great product this, by the way, and if we look at gold, let's look at gold over the last like 15 years. And let's look at gold prices from like the middle of November through to like end of Feb. Starts it November. Let's do it from like, you know, the middle of November-ish, right? What you see is oh, sorry about this. Do you see here how gold prices disproportionately rise? Now, a lot of this upside in gold is from the start of the year. So if I just did this, say you look at December, the strong period for gold is coming up from December through to you know, end of Feb. Do you see that? Like 13 gains and only 2 losses. And that loss last year, the largest one, was easy to see because it was easy to see because the COVID-19 restrictions, the normal drivers for gold upside were not in place. And that's normally physical demand around the Chinese Lunar New Year. Do you see? So that was easy to see that was not going to be valid. So usually if China's Lunar New Year is celebrated as it normally is, then there's a lot of strong upside for gold. So do you see how you're sort of putting all these pictures together, and then you're looking at the monthly chart, you're thinking, well, that could be, you know, we could be looking at a test of all-time highs here. And look, what are you actually risking? You're only risking, I was risking from about here, sub 1800, I think, with my stops below 1755. So I'm risking, what, $40, $50 of price movement to make, you know, $400, $500 of price movement. Happy days, right? So you can see now how all of this comes together. Now, I've shown you how to do technical analysis using trend lines. And, you know, I've shown you how to do it using some candlestick patterns. There is a wealth of information. I could do a webinar in and of itself purely on technical analysis, which wouldn't be a problem at all for me to do and would be well worth your time. But what I've been answering today is a very specific question. It's how to use technical analysis, right? Now, I've got a question here from Sharia, so I'm just going to look at this. Yash first. Yash, hi Yash. I see that you can characterize S support and resistance as zones, but if I might characterize as support and resistance in terms of strongness, in terms of stars, how do you know something is 1-star or a 3-star support and resistance zone? 1-star being the easy support resistance, while 3-star being the hardest to break. This is where you're going to have trouble, Yash, because look, some people will say, look, technical analysis is all you need because it's a perfect reflection of the fundamentals in price, you know. And I understand why some technicians might say that. But when you have a wider view of the market, you clearly understand sometimes things are going to break and things are not going to break. So why did I know, Yash, that there was a high probability that this trend line was going to break to the upside? And why do I know that there's quite a high probability that this trend line will break? Now, if you just say to yourself, because it's had 5 touches, it's a 5-star level, or because it's had 4 touches, it's a 5-star level. That doesn't take into place the fundamental aspect. So you can't just by looking at a line saying, oh, that's a key level. With that being said, Yash, the general rule of thumb is the higher the time frame, the more significant the level. So this is like a monthly chart, right? So you see the monthly chart, you see we've got this support resistance here and here. Mark my words, this is a huge level, Yash, right? That's 3-star. It's on the monthly chart. That 1700 region is massive. It's a big round number, huge, 3-star, okay? Similarly here, do you see this support, this resistance? Look at this. 1, 2, 3 touches. That support is huge, but do you see here how it closes above that level and then it takes off? So, Yash, what you're talking about there is, in my opinion, is the wrong way for you to be thinking about it. Now, I know that's controversial, Yash, and I understand why you want to do it like that. But what I'd say to you is think about technical analysis in terms of the fundamentals as well, okay? When you think of it in terms of the fundamentals as well, then you'll be looking at a level and you think, oh, okay, well, that level's more likely to break, or that level's less likely to break. Now, I cover this all the time, day to day, and we were covering this recently with, like, the Bank of England had a bit of a dovish shift this week, okay? And we were selling the pound, and I was selling the pound, a lot of the other guys were selling the pound, and price was moving down into this level here. And there was one chap who was saying to me, you know, well, what should I do? I'm short the pound from this level. I'm short the pound from up here, and price moved here. And there I was like, well, look, that's a key support level. So take your profit. Because is the story strong enough, big enough for it to keep moving? Usually it isn't. Usually it isn't, okay? But, you know, I hope, Yash, I hope some of that helps, Yash. Your very quick answer is the higher the time frame, the more the touches, the more reliable the level. But I would encourage you, Yash, to not simply look at it from a technical perspective, but include a range of analysis that will serve you best for the long term. Sharia, hello. Apologies for gate crashing, no problem. Although I've gained tremendous knowledge of fundamental and technical knowledge intraday trading thanks to your daily webinars. However, there's still one area of my trading that I'm not yet able to confidently control myself: risk management, specifically the 1% rule. 1% of each trade, or 1% of my account that I started with, or 1% of my remaining current balance, if your webinar time permits. Many thanks for your kind assistance. Sharia, absolutely fine. I'll deal with that briefly now, and feel free to ask a question in the regular day-to-day webinar as well. I'm glad you're finding it helpful. In order to confidently control yourself, one of the first things to do, Sharia, is don't trade with leverage. So trade without leverage. So let your trade size match your account size. So if your account, say your account's $10,000, then let your trade size be $10,000. So 0.10 of a standard lot. That really helps, okay? You need to get that risk management down, because or else you're going to be losing money too quickly. You're going to be making psychological errors only due to the amount of money that you're risking. So it is something to work on, but the simple solution, Sharia, is to trade without leverage. You know, I only trade maximum leverage like 1 to 3, maybe even 1 to 4 on a rare occasion. Okay. And I know brokers can offer 1 to 200. This is crazy. But the less leverage, and I often use less than a leveraged account. So I hope that helps, Sharia. Tima, what's the optimal RR to enter the trade? Wow, you know, what's the bigger the better, right? But there's also, Tima, something called expectancy. Now, expectancy is something like which direction do you expect the trade to go into? So sometimes I will take trades with a very low risk to reward ratio, but I've got a very high expectancy. So you can study this, and I'm sure you may be studying this in your course, how to work out probability using expectancy. So the optimal, the higher, the better, but I don't worry about risk reward as a general rule because I focus on expectancy. So to what extent am I expecting this trade to work out in my favor? And so I have a different risk management style, basically. But yeah, if you're using a risk reward, look, come on, the higher the better, yeah? Gavin, do you think there's a risk for traders that a strong technical setup might sometimes bias the fundamental outlook? Yeah, Gavin, a more advanced question, but nonetheless very valid. So sometimes you do get a very interesting move ahead of time. So let's look at the 10-year yields. So if you look at 10-year yields, you know, look at this. I'll just put this into a candlestick chart. It's a bit easier to see. Look, you've got a head and shoulders reversal pattern in the US 10-year yields. So left shoulder, right shoulder, head. Was that a tell that the market was expecting a more dovish Fed? You know, hence we had the head and shoulders pattern. I think there's something to it. The difficulty is, Gavin, is it's very hard to really quantify it, to, you know, put it out of the region of, you know, not superstition, but, you know, the trader's hunch. So there's all sorts of times like that. A bit like the gold market now. You might say to yourself, well, hang on, you know, did traders know, you know, this symmetrical triangle pattern was forming? Well, in one sense, like I know there's a lot of gold buyers who are very confident about gold's long-term outlook. Now, I have not been so confident about gold's long-term outlook, and I'm still willing to change my bias on gold. I never ever want to be in a situation where I think a trade can't fail, or there can't be something that comes in that changes it. Never. I think that's a very dangerous attitude for a trader. So I'm always flexible. I'm always wanting to be open. I'm always keeping both options on the table. It's helpful. But like I know one fund, they were like 16, 19% down on their account because they'd been buying in gold like heavily up at these levels. You know, with price moving lower, they were just convinced that gold's going to go higher. Now, you know, going back a few months ago, would I have had the conviction that gold is definitely going to move higher? No, no, no. No way. But now I'm seeing yields fall. Now I'm seeing the dollar fall. Now I'm seeing the tech break. Now I can define and limit my risk. Like, okay, what's the worst that's going to happen to me? Well, I'm going to lose about 2 or 3% of my account. Oh, that's a horrible day. I'd hate it, right? But I'm not losing like 25, 30% of my account. For me, that's an intolerable risk. So Gavin, yeah, there's definitely something there's something with what you're saying, Gavin. Definitely, it's more sort of nuanced and more kind of advanced topic, really. Okay, folks, I've run over that an hour, which was how long I'd allocated for this webinar. But I will have a brief period now for any extra questions. So if you have any questions, please do ask them now. Thank you for the questions that you've asked. They've been very good. And I do hope I've been able to share with you the benefit of my experience and some of my opinions that I've developed over years of trading, as well as the orthodox presentation for you. So I hope you're able to distinguish the difference between those two, as well as giving you the resource for a nice orthodox foundation, which is a really great beginning. I hope that's been helpful. If you have any questions, further questions, please do ask them now, as I have another 5 minutes or so if you would like it.
Any question?
Maria, good question. What's the best way to learn trading as a beginner? The best way to learn trading as a beginner is to have a daily mentor who can help you understand the market day to day. You also need to do a significant amount of reading. So learning to trade is incredibly complicated and difficult. It does actually take years, and there's many different nuances to it. But the fastest way is to look at the market each day, to have a trader who can explain it to you. That's what happens at a lot of these prop trading firms. A graduate will come in and they just get alongside an experienced trader and you pick it up like that. It's very hard to write it all into a book. There are some courses available and around. Some are better than others, but the best way is actually a mentoring. I hope that helps, Maria.
Any other question?
Well, very good. Thank you very much. I hope you've found this presentation helpful, and you will know now how professional traders use technical analysis to make trading decisions. So, oh, Anas, when it comes to cryptocurrency, many people suggest to only invest an amount of money that you're willing to lose. As a trader yourself, to what extent is this true? It's 100% true. You never, ever, ever invest more money than you're willing to lose. And I mean, say you had an amount of money, Anas, and you said, oh, I'm willing to lose this amount of money. Be very careful, because you may find that if you did lose that money, you may think very differently about it. So what I always recommend people who are beginning to trade is obviously demo trade, but when you're trading, try to aim for double-digit returns and trade without leverage. So that's the best thing to do. But you should, look, when you sort of, you know a bit more what you're doing, you can use a little bit of leverage. But like I'd say to yourself, like you think to yourself, well, maybe after 10 years, I might use a little bit of leverage. If that gives you a kind of indication of what my views are on that. If you want to follow me around ever, I've got a Twitter handle. That's my Twitter handle, @Giles Coghlan CCA. I'll just put that in here. So you can always follow me on Twitter. And I will also give some updates because for you guys and girls, I'll give some updates how I'm managing that gold trade. Okay, so you can follow along and see how that works. I also have a profile page on LinkedIn. You can also follow me along there. I'm just putting the links in the chat box. And, you know, you want to say hello or tell me how you're doing. And if there's any ever advice or questions you have after the event, I don't mind asking some questions and helping people if I can. So feel free to contact me and say hello. I'm a friendly chap, so you're not going to irritate me. I think that's all the questions that we've got through now.
Yeah, I think that's all. Thank you, Giles. Thank you. Thanks a lot.
Thank you very much. Been a pleasure. Thank you, everyone. Take care now.
Hope to see you.
Yeah.
Okay. Hope to see you soon in AUD face-to-face.
Yeah, it'd be lovely. Thank you very much. Goodbye.
Thank you. Bye-bye.
Thank you, everyone.